Simple moving averages are touted as an amazing trend following tool, and if we apply the moving average strategy using the 200-day moving average to the Dow across its entire history, you will see that it outperforms. Today we are going to look into different variations of this strategy, how we can apply leverage to it, and which moving average parameter in the form of the duration we choose is the best. The Dow is perhaps the most optimistic version of this long-term backtest, the reason being that almost all of the outperformance is made between 1929 and 1935. Following this time period, these gains are simply held until now, and if we start the simulation following the Great Depression, we will see that these strategies actually underperform. So to treat ourselves with a bit more pessimism, we are going to use the S&P. We are going to start after the Great Depression, and if we do this, we will see that the moving average strategy underperforms significantly across this period, despite avoiding some of the major drawdowns. So if we can turn this into significant outperformance, then it's more likely that there is some real performance to be had. The first thing I'll do is go over a very simple description of the strategy parameters and goals. In this case, the simple moving average strategy is very simple, at least this strategy is. When price crosses above it, the strategy enters. When price crosses below the SMA, the strategy exits. The goal is, of course, to capture trends, and we will see how different periods adjust for that. The strategy is either fully invested or fully in cash with no partial positions, and we are always assuming that the execution price is the closing price of the day. The fees associated, for now without leverage, are 0.12% on transaction costs, and that's about it. It's also worth noting that if we include dividends, including a cash yield when out of the market for the strategy, the underperformance intensifies. The dividends are calculated based on these parameters, and they are intended to simulate the likelihood of missing dividend payments, either because of not qualifying for them or for missing out because you are out of the market. This may be slightly pessimistic, but there would also be other drags on such strategy in the form of taxes or something else. So being a bit pessimistic, I think, is reasonable. For most of this, we are not going to include dividends, but it is nice to show that. If we do look at this on a log scale, we will see that it actually outperformed until around 2000 and underperformed following that. I find this very interesting, though if we toggle on entry and exit prices, we can see that there was a bit more trading following this time period. Before we move on, it's very interesting to see how things shifted across different 20-year rolling time periods. And before we get into the leverage, let's change the moving average period to see how these strategies perform with different parameters. If we cut this in half to 100, the performance gets significantly worse. If we move down to 50, it doesn't change too much. Going in half again, it continues to get worse. Going down to 10, worse still. And going down to 5, even worse. So far, 200 has been the best, so what if we go higher? If we go up to 300, performance again gets worse. For 400, it stays roughly the same as 300, and at 500, it gets worse yet again. Of these, the best seems to be 250, though perhaps to conclude that 250 is the best is to overfit, as it's very easy to look back at what did the best. Before we continue on, I'd like to point out something super interesting, which is the 5-day moving average outperforming until 1987 or so, after which the switch completely flipped and it started to do horrible. But if we zoom in on some specific periods here, the performance was quite unbelievable despite the incredible amount of slippage and transaction cost. But moving back to the topic, we can conclude that the standard 200-day moving average is roughly the best, and now we can look to apply leverage. If we apply 2 times leverage, the performance becomes staggering due to the fact that largely volatility is muted as we avoid significant drawdowns, but also large portions of rallies. However, do note that the colors shift when I change these toggles. The 2 times leverage ETF price, based on the index itself, with no strategy applied, also outperformed. So I don't know if I would call this true outperformance because we are still underperforming the leveraged version without any entries or exits. However, when we move up to 3 times leverage, things change drastically. The strategy performs the best. The basic 3 times ETF outperforms the base index, and the base index performs the worst. But the strategy significantly outperforms the normal 3 times leverage version because we finally get to a point where we are removing enough volatility to make it worthwhile to add leverage. And even if we move into a more pessimistic time frame from the top in 2000 until now, we see that the moving average strategy outperforms, the leveraged version without any strategy underperforms, and the base index takes the silver medal in this case. However, if we go down to 2 times leverage, the base 2 times ETF would have been the best performer. And as we discussed in the last video on leverage ratios, 2 times was found to be the best of all of the leverage ratios, and we are seeing that in action here. But over the very long run, it is very obvious that nothing compares to the 3 times leverage moving average strategy. Now, what happens if we use a different strategy altogether? I thought this would be interesting to simulate, so I've added it here. It is a simple strategy that seeks to further reduce the amount of trades taken by basing its decisions on the direction of the moving average itself rather than whether or not the price is above or below it. The parameters are as follows. The moving average must rise or fall for 10 consecutive days, and it seeks to only generate signals when there is a complete trend reversal. So it's not whether or not price moves above or below the moving average, but whether or not the moving average itself changes direction. If we zoom in on the 2000 instance in particular, we can see exactly what happens. If we toggle on the moving average, we can see that the moving average changes direction exactly once, and it does not change direction again until far after the low. There is exactly one exit and exactly one entry. If we remove the leverage, we can see this more clearly, and in the case of the original system, there was a significant amount of exiting and entering, while with the direction strategy, there was exactly one exit and exactly one entry. If we look at this in the long term, we can see how there were far fewer exits and entries, and therefore noise was a bit more reduced. And while it did underperform the first strategy in the long term, across the last 20 years, it has done far better. And if we showcase leverage, we finally have something that outperforms the 2 times across the last 2 decades, and certainly when using 3 times. Now let's look at some other things beyond the S&P across a little bit more recent time horizons. In this case, we're looking at the Nasdaq starting in 1985. The simple moving average portfolio would have underperformed significantly. If we look at a log chart, we can see exactly why. Just significant amounts of slippage, and while we do avoid some major drawdowns, avoiding them does not make up for the amount of slippage we witness. Even in the tech bubble, there were still significant rallies that moved above it, and in times like this, if we zoom in, we see multiple iterations of buying high and selling far lower across a very short period of time, that in this case results in a near 20% decline when the index itself did nothing, though it did have significantly positive performance across this entire period. If we add the moving average direction portfolio, we see a much tighter correlation. We see it effectively avoid the tech bubble decline and largely resume following accurately into current times. If we go back to the original one and we add leverage, it does outperform, but it does not come close to outperforming the base leveraged index. However, when we go to 3 times leverage, even the original moving average system does outperform both the base index and the 3 times leverage version. If we look at the moving average direction system, it does outperform its 2 times leverage variant as well as the base index, and it certainly does when using 3 times leverage, due to the fact that it correctly avoided a lot of the volatility following the tech bubble and even into the great financial crisis, which I think is very interesting. There are a lot of indexes to cover, but we have covered the main 3 so far, the Nasdaq, the S&P, and the Dow. Let's take a look at some more interesting examples and some individual stocks. Let's start with Intel. Hasn't done anything in over 20 years. Might be something interesting to look at. Not everything has trended higher in the last 20 years. It had a significant trend into 2000 and then puttered out following that. If we look at the moving average portfolio, we underperformed in most situations here, though we did outperform slightly from 2000 into current times, though only because we are now at a time in which Intel has moved significantly below its 200-day moving average. However, if we look at leverage, the 2 times leverage strategy outperformed the 2 times leverage of the base index. And this is also true for 3 times leverage, though in this case the total return was still negative, so I don't know if I would really call that a win. If we look at the moving average direction portfolio, things are actually worse this time, though performance from 2000 to current times is perhaps slightly better. In this case, it underperforms the 2 times leverage of the base, though it outperforms in the case of 3 times leverage. Looking at something far more recent that is also far from its all-time highs, we have Arkk. If we look at the moving average portfolio, it actually underperformed across this period, though it did outperform its 2 times leverage counterpart, and certainly its 3 times leverage counterpart, but it still underperformed base in this case, so I wouldn't really call that a win. In this case, the moving average direction portfolio did very well. It mitigated most of the drawdown, and certainly outperforms its leverage counterparts, especially 3 times leverage, of course. We've done some of the worst examples. Now what about the best example? Nvidia since inception. The simple strategy did underperform, but if we use leverage, it turns into significant outperformance, especially relative to its 2x counterpart. And while it underperformed for a long time in 3x, it did end up outperforming. Of course, Nvidia is a very volatile underlying, which means that its leverage counterparts, regardless of strategy, it's going to see far more leverage decay. And in this case, the 3 times ETF actually went to 0, because if we look here in August of 2004, it declined over 33% in a single day, enough for the leveraged 3x version to go completely negative, therefore to 0. What about the other strategy? Slightly worse in this case, but if we apply leverage, it gets even worse, underperforming the base in its entirety, though still outperforming 2x base, and same for 3x. The last thing that we are going to look at is the ever famous Nikkei. Before we continue, I would like to just iterate again that the 200-day is still the best. 100 in this case is virtually identical, as is 50. 25 does very well for a time, but ends up being worse, as do shorter ranges like 10 and 5. And if you think this is misleading heading up to the high, or that I am not calculating transactions correctly, here's what the 200-day looks like if I don't calculate transactions correctly, and here's what the 5-day looks like. Quite incredible. I don't know how this is possible. I don't know why it happened in the 70s in the Dow and the S&P, but if we don't add those transaction fees, this is what it would look like. This would be amazing if it was real, but it isn't. Moving back to reality, we have the performance charts here. This is the simple portfolio. If we add leverage, of course, it outperforms, and it very significantly outperforms its 2x counterpart, and certainly is 3 times leverage counterpart, mostly due to the last 40 years, but avoiding volatility is sort of the point, so I think it's fair to say that it did its job. Now what about the moving average direction portfolio? Slightly worse performance, but it does end up having a positive return across the last 30-40 years. So if we use 2x leverage, it does quite well, though it underperforms the simple portfolio, as is the case in 3x, though both do quite well across this period, especially relative to their leverage counterpart. That's all that I have for you. I hope that you found some value in this today. If there's anything you'd like me to add to this, or any other entirely different subjects you'd like me to cover, let me know in the comments. If you think that I made any mistakes, leave those in the comments. Like, subscribe. That's about it.